Welcome, everyone, to the February 22 Realtor Training Opportunity. I just want to remind everybody that we do answer all questions at the end. So if you'd like to put those in the chat, then we'll address those all at the same time. Go ahead and give it. And today's guest speaker, we actually have two. They're both with Mountain West Financial. And Debbi Bakke, she's a business development manager. Debbi, I'm going to turn it over to you, and then you can go from there.
I want to thank you for inviting Nancy Obando and I here today to go over the importance and various helpfulness that down payment assistance can bring to your buyers. Our goal today is to encourage MLOs and their real estate partners to recognize that buyers using DPAs can be just as qualified to purchase as others who may be bringing a larger down payment to the table. We want to clear up some of the misconceptions surrounding down payment assistance programs, and we also want to highlight the importance of these DPAs in underserved communities. Mountain West Financial has been in business for over 30 years, and every day we live our motto, making homeownership a reality. And down payment assistance programs are an integral part of that mission. Besides offering, very, very vanilla products like Fannie Mae, FHA, VA, and so on, we're one of the largest providers of down payment assistance programs in California. And while we offer DPAs in every state where we lend, clearly, California has the largest numbers of programs to offer. I'm co-presenting today with Nancy Obando, our Senior Vice President of Affordable Housing. And dang, she has some impressive credentials. We're very blessed to have such an energetic and mission-focused woman at the helm of our division. I'm going to mention just a few of Nancy's accomplishments so you have a sense of how committed she is to our industry and the partnership between buyers, originators, lenders, and the real estate community. Nancy has more than 20 years of experience in corporate banking, and currently Nancy is serving on various boards such as, and this is a long list, she's the treasurer for Mana de San Diego, an organization focused on mentoring and empowering young Latinas. She's a certified spokeswoman for the National Association of Women in Real Estate Ecosystem. She's on the board of directors for AREAA National Foundation. She's a graduate of the Multicultural Women's Executive Leadership Program at the USC Business School. And she's certified in the art of skill and negotiations through the Resilient Leadership Program at UC San Diego. She's also the 2022 president for the National Association of Hispanic Real Estate Professionals, the Montebello Southeast Los Angeles region. As a CRA expert and advocate for the community, Nancy has held many positions, including but not limited to being past president of the Asian Real Estate Association of America, Greater Los Angeles. She's a founding board of director member of the National Association of Minority Mortgage Bankers of America. Nancy has been recognized as a real estate expert on Univision. She's received many recognitions from the city of LA, the county of LA, Congress, the US House of Representatives, and she was recently named as a top 40 under 40 award recipient. She's received so many more accolades for her various contributions within the community. And with all of her accomplishments, Nancy promotes diversity, equity, and inclusivity, and she's a respected voice within the community. I like to say that our Mountain West employees swallowed the Kool-Aid when we were all hired on when it comes to community involvement, and certainly Nancy is a fine example of someone who lives and breathes those ideals. That list was long. I took a long time. I wanted to make sure I got as much of that in as possible. So Nancy, do you want to take us away?
Yes, thank you so much for that introduction, Debbi. If we could go on to the next slide, please. So today we're going to discuss the future of homeownership, and as Debbie discussed, the importance of really knowing the best options for your borrowers. There was a survey that we took, and more than 75% of the respondents said they were familiar with FHA mortgage products. However, only about 20% were familiar with conventional mortgage products that offer 3% down payment options or down payment assistance options. And these mortgages often represent better options as they don't demand as much upfront cost or have cancelable mortgage insurance when equity reaches 80%. So saving significant money each month, and it can be paired with other down payment assistance programs and funding sources. Homeownership is critical for building long-term wealth, and first-time homebuyers rely on obtaining mortgages to become homeowners. So after the financial crisis, mortgage rates, declined substantially by all races and ethnicity. The fastest growing population of potential homebuyers is the millennials, and that's slowed down as well because it's slow to obtain. It's harder for them to obtain home mortgages, partly due to differences in social demographic characteristics and preferences from earlier generations. With rising house prices, lack of inventory, and lending standards following the COVID-19 pandemic crisis, the path to homeownership has become even more challenging for potential first-time homebuyers, especially for minorities. Blacks and Latinos have been particularly struck by the pandemic crisis since they are overrepresented in low-wage sectors or jobs that cannot transition to remote work. So despite a generally weak economy, many future homebuyers could qualify for a mortgage in today's marketplace. And that's what we want to talk about, people who are mortgage ready and how we could get them there if they're not. Next slide, please. So on this slide, we have mortgage ready population. So we focus on people of ages 45 and younger because the data didn't allow us to observe tenure status of consumers. Older homeowners are more likely to own their houses free and clear. And census data suggests that homeownership rate increases with age, but the mortgage ownership rate peaks at around 45 and declines thereafter. Therefore, we use the age 45 on this graph as a judgmental cut point to exclude non-mortgage homeowners who are potentially homeowners already. So if you could take a look here, you could see the overall appropriate population that is mortgage ready. We look at percentage, we look at 36%, and then that is broken down by demographic and ethnicity, with non-Hispanic whites, Black Americans, Hispanic Americans, and Asian Americans. Why do you want to know this information? It's because we are, heading into the spring buying season. So it's really important to take actual data analytics and build that into your 2022 business planning strategy. And then just as a reminder, if anyone has any questions, please drop it in the chat, and I'm sure that we will pick them up later. So next slide, please. Understanding the debt to time to save affordability of mortgage ready population. I wanted to bring this demographic as well because it actually showcases how long it would take a potential mortgage ready person. Let's say they have great credit, they have great income, however, they don't have that 20% down. And 30%, 36% of potential mortgage ready home buyers believe that down payment is still the deterring factor for becoming a homeowner. So if you take a look at the slide here, it ranges between 16 to 23 years for someone to save 20% down. I don't know about you, and I know that we have our pipeline and we want to keep our clients for a really long time, and we do our follow-up, and we have them in our database, but I don't want to wait 16 to 24 years to potentially have a client. I mean, if I could shorten that time to have a client mortgage ready, anytime between 2 to 3 years, or even less than that, I would prefer that than waiting 16 to 24 years. So it's really important to know what products are available for your clients, so you're not stuck waiting 16 to 24 years for a potential buyer. I don't know about Debbie, I know I could talk a lot. Did you want to add anything to that?
Well, you mentioned millennials. There was a statistic that was just out that stated only 15% of millennials today are saying that they want to be homeowners. Those who are not already homeowners, of course, and that's probably having something to do with perhaps being raised in a household whose parents went through the mortgage crisis starting in 2007. It's that they're listening to the news that's going on today in our economy and wondering, gosh, is this really the best time for us to purchase property? But millennials comprise the largest segment of potential homeowners in the United States. So it's really important to be able to tap into those millennials and help them understand that, like Nancy said, waiting to save 20% for a down payment isn't realistic. And by whoever thinks that they can wait 16 years to purchase a home just by steadily saving money towards that 20% down payment, this isn't, of course, taking into consideration, inflation and all of that. They're going to miss the boat. We don't know what's going to happen, 2 weeks from now, let alone 20 years from now.
Mm-hmm. And I know that right now, with the lack of inventory, it's maybe a little bit harder, or they're, afraid to get into the market, or they're saying, some people still think that there's going to be a housing bubble, and, homes might tank, and we're at the top because of affordability and things like that. But I would counter that and say, even though right now, homes are high in price, there's still opportunity for wealth creation through home ownership. If you bought just 2 years ago or 3 years ago, you more than likely have built a lot of equity by then. I mean, the average equity of potential homeowners now, it's about $56,000. Of accrued equity if you just bought a couple of years ago. So for me, homeownership is a long-term process. It's the biggest investment that someone is going to make, but there's still opportunity for wealth creation through home ownership, even if you buy today. Next slide, please. This gives a more expansive look on how much it would we were talking about 16 to 24 years to save for a 20% down payment. This is the time heat map for the time to save for a 3% down for the mortgage ready population by county and race and ethnicity. And remember, I said 16 to 24 years for a down payment, 20% down. You could see how that gets slashed from anywhere from less than a year to about 5 years, depending on where you're at, to save for a down payment. Next slide, please. So again, we're here to help you create more buyers. And for those buyers that still need down payment assistance, we do have down payment assistance options available. Like I mentioned before, the number one obstacle for most home buyers is the down payment, but help is out there. We do have a ton of tools that you could reach out to Debbie. She's very well versed on the tools that are available to us in order to search for down payment assistance programs. As Debbie mentioned, we do have over 120 options for down payment assistance, combined assistance. And down payment is not just down payment assistance is actually not just towards down payment assistance, even though it says down payment. You could also use it towards closing costs, or you could save your potential buyers money by using the down payment assistance towards closing costs or down payment, and then having them keep their savings for potential repairs or for that washer and dryer that they want to buy for their new home or new furniture. Of course, after they close, don't have them buy it before, when they're going through the home buying process. Did you want to add, Debbie?
No, I think you covered that really well.
Okay, next slide, please. I don't know if you want to take that one on, Debbie.
Yeah, I wanted to kind of address the myths that surround buyers who use down payment assistance, and hopefully put to rest some of those concerns and open up that dialogue a little bit more. One of the biggest critiques that I hear is that down payment assistance buyers are less qualified. And I want to give you an example. CalHFA, which is one of the largest providers of down payment assistance in California, for conventional loans, they require a 680 credit score. Standard Fannie Mae, Freddie Mac is 620. They will limit the borrower to no more than 45% back-in ratio. Yet we know that Fannie Mae and Freddie Mac will also go up to 50%. On an FHA loan, although the credit score right now for CalHFA FHA buyers is 640, recently it was as high as 660. We know that lenders everywhere will approve buyers with a credit score on FHA of 580 and above. Mountain West will as well. Although FHA allows for credit scores down to 500 with some stipulations. Also on an FHA loan, HUD allows that back-in ratio to go as high as 57%. But CalHFA will limit them to 45%. So clearly that borrower, when matched up against another FHA buyer, really holds up very, very well as far as their qualifications go. Their income is solid. Their funds to close is where the issue is. And there's a lot of reasons why the buyer may not have sufficient funds to close and need to rely on down payment assistance. They may not have a family member that they can get gift money from. They may have been counseled by that loan officer very, very well that, gosh, Bob, you don't have sufficient ratios to qualify for a purchase. We need to get these debts paid down or paid off in order to qualify. So if that buyer had sufficient funds, now they're being eaten up by paying off debt to qualify. So down payment assistance comes to the rescue. Another one of the myths is that down payment assistance loans take longer to close. Truly, when you are pairing yourself with a good crew like this who understand clearly how to process loans, what makes a qualified borrower, that shouldn't take any longer to close than a standard loan. Mountain West Financial does true TBD approvals. We don't just take an AUS and blast that out and say your borrower is pre-qualified. We actually put that all the way through the underwriting system. So the underwriter is measuring income, assets, credit, and potential occupancy issues. And if the processor and loan officer work together and get those conditions met while the buyer is still house hunting, then that loan can close probably within 2 weeks after they go under contract, because all that's needed then are disclosures, appraisal, escrow, prelim. Did I hit it all? I think that's it. And we're ready to go. Some people say, well, down payment assistance don't work in my area. I have high balance properties, or, or I have an abundance of condo, whatever the story is. We work with a couple of down payment assistance programs that will do high balance loan limits. CalHFA for one. they say that DPA loans aren't good for the market. I never quite understood how that wouldn't be good for the market, because home ownership sets a path of generational wealth for those buyers. That buyer moves into a neighborhood and they send their children to that school, and they shop and they purchase their groceries at that Stater Brothers and buy their nuts and bolts and widgets at Home Depot. They're contributing to that neighborhood. Home ownership is good for the market. DPA appraisals are more strict. I'm not quite sure where that came along. We know that there is a difference between how appraisers review an FHA loan versus a conventional loan. But for the most part, most of the appraisers don't have any idea that there's a down payment assistance involved in this transaction. So that's not something that really is measured. Another thing is that, gosh, we did a down payment assistance program a long time ago, and it was just such a mess. Nobody seemed to know what they were doing. Mountain West Financial has been doing down payment assistance, I'm going to say, about 20 to 25 years. We've been in business for over 30 years. So a good portion of that time has been devoted to these products. When I came on board with Mountain West Financial, right after the mortgage crisis hit, I didn't even know that these programs existed. I had no idea that a borrower could get assistance not only for the down payment, but for closing costs as well. So I had to hurry up and amp up my knowledge and learn how to do these, so that when I was talking to loan officers and processors out there, I could help them with those products. Some people think that the programs require that the borrowers be a first-time home buyer. We have programs where the borrower can actually own a home. It'll have to follow standard FHA, Freddie Mac, Fannie Mae guidelines. But most of the time it's because that borrower sold their house, or maybe even lost that house in a foreclosure or short sale situation. We can go FHA in that instance. And even though they've owned a home within the most recent 3 years, it doesn't preclude them from being able to use these down payment assistance programs. So while a lot of the programs are strictly for first-time home buyers, no home ownership in 3 years, there are other programs that don't have that requirement. Next slide, please. There's also some really good reasons why a borrower may rely on down payment assistance programs. So when the property needs some TLC, when mama walks into the house and she sees the old-fashioned tile countertops or linoleum floor, she says, oh, there's no way, I can't have my bunko group here, or I'm not going to host Thanksgiving dinner if my kitchen looks like this. So they had the money for their down payment and closing costs, but now they found a house that's perfect for them in their school neighborhood, or it's close to their job, or close to other family members for childcare. But now they've decided, you know what, let's use the money that we've saved up to improve the home after we purchase it, and we're going to use somebody else's down payment assistance money in order to acquire that home. And that's perfectly reasonable, right? Buyers may be short on funds to close and they don't have family money. This helps to bridge that gap between not being able to purchase that home on that day in that neighborhood, which is perfect for them, and making them wait longer in order to acquire a home. Perhaps in that length of time, interest rates will be rising or sales prices will be rising. It's an affordability issue that down payment assistance can come to the table with and bridge that gap. With increasing sales prices, we see, of course, that means that the loan amounts are increasing. Having their own funds available or using down payment assistance funds to make up that gap between an increase of, say, $50,000 on the sales prices that they had hoped to have, but now looking at the market and saying, oh gosh, the houses are a lot more expensive than we thought. We budgeted for this, we're going to need this more. So having the ability to rely on down payment assistance funds to help them reach that goal is an excellent reason to use these loans. We know that I mentioned that there are some of the down payment assistance programs that will do high balance loan amounts. So, and we know, MLOs and processors know that when you look at a lender's rate sheet, that the interest rates and pricing are always higher on high balance loan limits over and above the Fannie Mae, Freddie Mac, FHA conforming loan limits for that county. If we exceed that amount, that interest rate and pricing goes up. Sometimes that's the difference between making that home affordable and not affordable. So what the down payment assistance can do is to bridge that gap and allow for a higher down payment to bring that loan limit down to conforming loan limits, thereby making that home more affordable for the borrower. I mentioned that, having additional funds to pay off those debts to qualify is a really important factor that we see a lot now. It's not unusual for a loan officer or processor to believe that this is the income that the underwriter is going to use in order to qualify my buyer, only to find out, well, because of a gap of employment or reduction in, say, overtime earnings, that income isn't quite as high. So now, in order to meet that debt to income requirement, we need to pay off debt to qualify. So this is an excellent opportunity to make that happen. And if they were using all of their money to pay off that debt, they may not have enough money left over to put for the down payment and closing costs. Next slide. We have marketing materials that we have available on our website for loan officers and processors to access. And those marketing tools can be co-branded with their real estate partners. So I want to encourage the MLOs and processors on the line today to reach out to your real estate partner and make that an option for them, whether it's for presentations, whether it's to help meeting a prospective new buyer, sitting at an open house, for instance. That information is available for you. We have a lot of tools to help, as Nancy mentioned earlier, we have a lot of tools available to help with searching out which down payment assistance is going to be best for the client. When I get a phone call or an email for questions on down payment assistance, what do I need? Will this buyer qualify? I ask a lot of questions. There's nothing worse than not knowing what you don't know in a situation, in a scenario, because knowing as much information about that buyer as possible allows me to kind of pinpoint probably the best 2 or 3 programs for the buyer, and then let the loan officer and the buyer decide which of these programs really fits their needs best. Nancy, do you have anything to add?
Yes, absolutely. I think leveraging social media tools for business is one of the most important things that you could do right now. If you're not doing that, if you're not, putting out social content, or you're unsure what you should put out, or need any advice, please reach out to Debbi. We have so many resources available for you. Shareable content from the industry thought leaders is a good way to efficiently share valuable information and build trust and authority as an advisor and wealth creator. I think that realtors, just like mortgage professionals as well, as a realtor, you shouldn't just be a home finder anymore. I think that's the realtor of the past. I think now, especially with millennials who are super well versed and look for everything online, if you don't have content about yourself, or share who you are and share why people should be doing business with you, you might fall behind. So like I said, millennials can find a home on Zillow now. They could go on Redfin, but that's not going to provide the expertise that you have as a real estate professional. You know your business better than a Zillow or a Redfin, but people need to know that. So combining social media savviness with homebuyer education and knowledge can offer ways to future homeowners to be mortgage ready. That's all I have to say about that.
Very good. Next. Okay. So thank you, Debbie. Thank you, Nancy, for that. And I wanted to thank Juanita for putting in her comments into the chat. She had mentioned here on one of them that she encounters all the time that other agents they don't know about the program. So possibly in your marketing or your pre-approvals, is that something that you guys can address how to?
Absolutely. And that's key. I mean, that's the thing, like I was saying, is just we have a wealth of knowledge. Use us, right? Use us. You guys are great at, the real estate market, finding a home, knowing what's valuable for it, but use partners like us that are well versed in mortgage products. Help us, reach out to us if you need the listing agent to understand the program, because that's another thing too, right? Sometimes the listing agent, you're submitting an offer, and the listing agent's like, what is this program? Like, is it even qualified? Reach out to your loan officer. The loan officer would be able to better help your buyer look stronger, for you. So absolutely, I completely agree. I think it's part of our job to help continue educate the community on what's offered out there. I know that new is scary, but it doesn't have to be if you partner with someone who knows what they're doing.
Very good. And then I just wanted to remind everybody here, I'll put it in the chat. So if you want to be paired with a mortgage loan originator, to email loans@REeBrokerCA.com, and then we'll connect you with one of our mortgage loan originators who can actually pull the information from Mountain West Financial's website for you and brand it as well. So thank you again for that information. So we're just going to spend a couple more minutes on a couple of things that we thought would be helpful to all of you. So this next part is about the importance of pulling title information. So through the years, I've used various websites to pull my information. There was one particular company, they were mixing up the bedrooms and the bathrooms. And so for whatever reason, I've just stayed with my first AM, which is First American Title. The information I pull from there is, I've never had any issues with it. So that's the one I'm going to use as an example today. So one of the things is you want to remember when pulling, you want to pull the title information prior to doing a listing, so you know who you're working with. We've actually had some issues where an agent will take a listing, this person signs the listing, when then they go to pull title, there is that person may not be on title for various reasons. The most recent one we had was they did a refinance and the wife was left off title. So it could be as simple as something as that, or, there could be various reasons. So you always want to make sure you pull title. After I go through this checklist here, I'll show you quickly how easy it is. Also, when you're working on a purchase agreement, you want to pull that information as well. You want to confirm that the address and the APN number is correct. As I mentioned, confirm the seller's names. Check the transaction history to confirm if there are any recent sales the buyer needs to be aware of. And then also pull comps and have the party you're representing initial and date them. So here I'm going to share my screen. And so as an example, I pulled up Disneyland. So there's multiple Disneyland properties here. And I'll just go in and quickly show you how easy it is to pull the information. And then hopefully, okay. So here is the name. It's under an LLC. So, there'd be additional RCSD paperwork that would need to go along with this, with your offer or even your listing. And then, verify that the address is correct. Sometimes somebody will get through a whole transaction and realize, oh, we've misspelled the seller's names or the address. That this is a good time do it right before you start a transaction. APN is here, and then the combined report is going to pull the whole, all of these reports here. You want to go in and you want to look to see, you know, it's a good, you can see the type of use it is. You can see who the owners are on this particular property profile report. Then, as I mentioned, if there has been any, they're not letting me see this one, but if there has been any transaction history on there, then you'd want to make your buyer aware of that. If it's within the last year, you know, you can see it. For instance, if the property is flipped, you know, there's going to be certain guidelines for different types of loans as well. So you want to go in knowing ahead of time. Also, this is a good time. We've had people take a listing and then they don't realize the property is in foreclosure or, you know, notice a default. So it's like, you definitely want to look that up. So this particular one, it's going to be a little pumps, but basically you're going to do by your years and your square footage, the apples to apples on that one. So that's one area I wanted to mention. The other one is most of the title companies have a section for farming. So you can go in here and pull the areas that you want addresses for. And then the company, this particular company will do it. Not sure that all companies will do it, but they will give you a packet of labels with those addresses on it. So you can do your marketing from there. And so, and then, Yeva, you want to share the screen again? Okay, so yeah, so that, as we mentioned here, you can go through any local title company to get that access and make sure you use it on your transactions and for farming and for peace of mind. So, okay, next.
Hi, everyone. So if you guys have any questions or comments, please be sure to put it in the chat right now. You can also email us at info@REeBrokerCA.com or call our phone number. One thing I did want to mention to all our agents is please log in and read your agent messages or the pop-up that appears about the new fee schedule. It's fantastic and it has a cap for you that's annual $15,000. So if you're going to be closing a lot of transactions, it's going to be really good for you. We're giving you guys until March 1st to make that switch if you want. Otherwise, after March 1st, if you're going to be closing any files, you'll still be part of the old fee schedule, which is about like for regular transactions, it's $500 plus the $135 if it's under 1 million. But I do want you guys to all look at that. So you see if it's, oh, thanks, Kathy. You see if it's the right fit for you and just make sure to contact us and tell us you want to switch or click that button there. So yeah, thank you, Kathy. So Kathy's showing where you see your agent messages. And then, yeah, the new broker split announcement. So just read about this and let us know if you guys have any questions.
Very good. Are there any questions before we end? Okay, all right. Thanks again, Debbie and Nancy.
It was my pleasure. Thank you so much for having us.
Take care.
Thank you. Bye.